Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the specially timed Friday edition of 7 Investing Now. My name, of course, is Daniel Brooks Klein, and joining me today is a big part of the 7 Investing team. We're letting Honorbon sleep in. Dana Abramovitz had to leave us, but I have Simon Erickson, Matt Cochran, Max Chatsko, and Steve Symington joining me on the call. Let's go around the room. Steve Symington, what are you drinking this morning?
I'm drinking black coffee, so pretty just standard choice for a Friday morning.
Max Chatsko, you are usually the most interesting beverage pick here on the program. What did you go with today?
Straight honey, Dan.
That is not true. That is our 8th advisor, Winnie the Pooh, who is not on the show today. I, of course, am going with way too much water for a day where we did a 10 a.m. call just for new members, an 11 a.m. call for all our members, which was an absolute blast. If you are not a member of 7 Investing, you missed out today. Simon, it's a long day. Have you Irished up your coffee? What's going on this morning?
Not yet. I'm just like Steve, drinking it straight, but there's quite a few refills throughout this day, Dan.
And Matt Cochran, did you at least go with some cream and sugar? What is going on? Who's drinking black coffee? What is going on here?
What's in my coffee mug is no one else's business. It's just sparkling water.
We are going to be taking your questions today. We've got a whole bunch of them from Twitter. We've got a whole bunch of them that we don't have a whole bunch of them. We'd love to see a whole bunch of them that we will take live. So wherever you're watching this, feel free to shoot any investing questions you'd like us to answer. Sam Bailey, our producer behind the glass, is going to be in charge of putting up the questions we had from Twitter. Sam, if you want to hit us with Shah Ravi's question. Question for each. If you were to start investing today, what would be your approach? Why don't we do this in reverse age order? I'm the oldest, but I'm probably not the one who's been investing the longest. And I know that in my early investing days, I didn't necessarily have a thesis. I didn't have a reason for buying a stock, or I had a really thin thesis, such as like, I like this product. Like now, I know the value of research. And I'll point out, you don't have to do that research. We could do that research for you. That is likely why you are a member of 7 Investing. Matt Cochran.
Yeah, so actually I just wrote for our members, I just wrote an advisor update on this question. But basically, look, I would look to be adding a little bit of money into the market each month. And with that money, I would try to put it into I basically categorize companies into 3 categories for my portfolio. And they're very loose categories, but I have some that are just basically just some that are more conservative, where I'm worried about not very little downside risk. Some in the middle, which I believe are just good growth at good valuations. And then some of the more riskier companies, which offer a very high risk, high reward profile. And I just try to diversify into those types of companies every month. So one month, I might really like a high-flying type of SaaS stock that the valuation's high, but the growth rate is higher, and I might buy that. But then the next company or the next month, when I add a company to my portfolio, it'd be probably a more conservative company to try to balance it out. And I just that's how I manage my That's how I would do it if I was starting off today.
Simon, I think you're next in reverse age order. I probably should have asked everybody their ages at some point offline before going in reverse age order. I'm always very conscious of which order I go in and not favoring anybody. But Simon, what would you do differently?
Well, Dan, you called yourself out first by putting yourself first in the line of the reverse age order, I think. The 2 things that I would do is first of all, go to your investor relations page of a company you're interested in. Read the investor presentation, get the feel for how the company thinks about itself and what it is pitching itself as to other investors. Rather than just seeing tickers and saying, oh, the stock is up 5 or 10% on a given day, actually try to understand the business and what they do, and also how the business presents itself through an investor presentation. And then the second thing I would do on top of that is go look at the definitive proxy statement. So if you look at sec.gov, you can look at the annual report or the definitive proxy, the DEF 14A statement, and then search within that for executive compensation. Why do I say that? Because, well, that's how executives are getting paid, and that's probably one of the largest that's at the top of the priority list, so to speak, of what the company is actually going to be doing. And so is it just revenue growth and just earnings growth, or is it something like they want to look at profitability and cash flows? That can tell you a lot about the business, even just looking at those two things.
And it's a real big challenge because when an executive is being paid largely in options, or that's a big piece of it, they have real short-term incentive to grow the stock price, which is actually not what's best for business. So that can sometimes be a challenge. Steve Simonton, you're up next.
Oh, if I was to start investing today, what would be my approach? I think I would continue to focus on the long term, and that's, I'm 38 right now, but I've still got, a good couple of decades before I have to even think about retiring. And I'm not convinced I'll ever retire, right? This is what I love to do, and I love to keep my brain working. But I think I would just do exactly what I'm doing now. And that's to find and purchase shares of great businesses that I think are going to succeed over the course of the next couple of decades. And that's, I think, something that will lead to life-changing wealth. So really just maintaining a long-term focus and buying great businesses that I trust will create value for shareholders.
And the youngest member of our team, Max Chatsko.
All good advice from my colleagues. I would just add, if you're starting to invest today in this market, I would invest in, quote, like safer companies. I think if you invested in tickers or some of these like social media companies, momentum stocks, YOLO, all those things, you might get discouraged, right? A lot of individuals have come to investing in the last year, and this has been one of the easiest years ever to be an investor. Everything goes up all the time. It's great. But if you invest in some of these tickers you just read about on Twitter, you don't have a thesis, you're not in it for the long haul, and later on you're down 60, 80%, you might get discouraged and not become an investor, or you might not remain an investor, I should say, like 2 years from now, 3 years from now. So you want to build up, your acumen and really understand what you're getting into. But, so pick some safer stocks, be careful what you're getting into, especially in this market. There are a lot of elevated valuations out there, so don't get discouraged. And if you are, maybe you didn't have a thesis, maybe you're, don't understand the companies you're investing in. So all good things.
And remember, we're in this for the long term. So the short-term noise is often not that important. We're going to bounce back and forth between questions we got on Twitter and questions you're asking live in the chat. We really appreciate you doing that. If you want to bring up Keith's comment, we'll try to take these in order. Sam, appreciate that. Keith wants to know, for high conviction tickers, do you consider investing in leaps? I don't, because I didn't know what a leap was until I saw that question. Simon, you wanted to take that one, I believe?
Yeah, we can take that one. This is an options related question from Keith. A leaper is oh goodness, Steve, long-term equity anticipation. Oh, I'm losing the letters. I forget what it stands for now, but it's a long-term call option that's typically longer than a year and a half in duration. And so this kind of locks you into a certain price that you could buy the shares at. If they are above that price, you have the option to buy them. And in exchange, you just pay for the premium up front. You don't buy the shares up front. You buy the option to purchase them at a later time. And so a lot of people that play options like the leverage of putting less capital up front, but still maintaining the upside if a company goes up. If it falls below that price, then you're not on the hook for buying anything. You're just out for the premium up front. Now, we don't do that at 7investing. We don't do any options. We are long-term buy and hold investors. But the appeal for something like this would be upside with limited capital. But again, I stress this every time we talk about options is don't jump into the deep end too quickly on these. Make sure you understand the risks that are inherent with things like this, because if done incorrectly, they can light a lot of money on fire very, very quickly.
Simon, thank you for that. We're going to take a question from Chooch next, if you want to pull that one up. The more companies you own, the closer you come to just being an S&P 500 index fund, and your gains reverting to the mean of the market in general. Big gains require a concentrated portfolio. A stock 10 timing doesn't matter if it's 2% of your portfolio. Discuss. I sort of disagree. Max Chatsko, you wanted to weigh in here.
Yeah, I was going to weigh in after Matt, but I'll go first. So I actually have a more concentrated portfolio, and that's a personal decision, right? You can have dozens of stocks in your portfolio or not. Maybe as I get older, I'll have more and more companies in there. But I do kind of agree with that a little bit. Now, if a stock's 2% of your portfolio and a 10X's, I mean, that's still a very large part of your portfolio. So, I don't necessarily, there's different ways to do it, I guess. And we just wrote about this as well. Matt, You wanted to weigh in?
Matt, feel free to jump in.
Absolutely. So like I guess what I would say is like this really depends on the individual investor. You should really know yourself. Like for instance, I know like if I didn't allow myself to have a larger portfolio with more positions, and if I was just going to run a concentrated portfolio, like I would not be as risky, or I would be much more risk averse than I am now. I would invest in more conservative companies, and like allowing myself to take smaller positions in riskier companies has worked out very well for me. A stock 10 timings, if it's 1% of your portfolio, does still move the needle for your portfolio. Like I will take that. If the trade-off is like knowing myself and knowing that I wouldn't invest in that company otherwise, I'm very happy making that trade-off. The other thing I would say is like many of the best stocks over the long term are very volatile, and it's easier for me to handle that volatility knowing it's just a 2, 3, 4, 5% position. If every stock in my portfolio was a 10% position, I don't know how it would stomach a 50% drawdown, which happens in great stocks. Know yourself. And if having a little less than a concentrated portfolio, allowing yourself to invest in more positions helps you like psychologically hack yourself, I think that's a good strategy to do. Just know yourself and what works best for you. Some people can run concentrated portfolios, and that's great for them. It's not great for me.
And you can have a very small position in, say, Amazon from the point, they went public, and you could be a millionaire now. So, we say 10 timing, but what if it 100 times? What if it even more than that? That does happen. I don't have a particularly concentrated portfolio. I buy the stocks that I like, and then I also buy the stocks that Max likes, and some of the other stocks the team picks, and I make relatively small bets in them. But as they get re-recced, I buy a little bit more if someone makes a re-recommendation, or as I start to learn them, they might move into the personal basket. It's really up to you. Damon, with a bunch of numbers, says, hello, everyone. Happy Friday. I closed my Dogecoin position. Would love to hear about Chainlink. I do not have a Dogecoin position. We do a wonderful podcast with our friends at Crypto EQ. That being said, I still don't understand blockchain, no matter how many times it's explained to me. So I'm very, very aware of it, even though I do trust the Crypto EQ guys. Who wanted to field this one? I think it was Steve.
Yeah. So actually, we did talk about Chainlink. If you go to 7investing.com, kind of near the top of the page, right under the recent insights and interviews, you'll see our podcast with Crypto EQ that we just released, actually. And if you go in there around the 21-minute mark, we talk about Chainlink a fair bit. So I think Spencer Randall dedicates a little time to Chainlink, and I think it's probably best to hear it from his mouth because he understands it a lot better than we can speak to here. But check out 7investing.com, look at the Crypto EQ interview. 21-minute mark is about where we talk about Chainlink.
And of course, to see that, you have to be a member. Our podcast with Crypto EQ is for members only. If you would like to become a member, that is very easy to do. You don't have to pay us in Dogecoin. You don't have to pay us in Bitcoin. You can go to 7investing.com/subscribe, sign up really easily to be a member. And of course, you get our 7 highest conviction stock picks each month, but you also get amazing things like our podcast with Crypto EQ. There's nothing out there like that. And because it's for members only, we can talk about it in much more detail than we can on a live show like this. We appreciate so many of you watching. We're gonna get to as many questions and comments as we can. I'm gonna take one more from the live comments before bouncing back to the Twitter. AI Weiss 18 says, what's the best investment option for a 21-year-old kid in college? I'm going to start with this. I have a 17-year-old, and we talk about investing. You might even see him walk by. That's why I'm pointing over there, because he is in the room. But that being said, we talk about investing and why, a company he goes to, so we're going to Universal Studios tomorrow. I'll talk about why I don't think Comcast, which is their parent company, is a great investment, because I think they have a lot of legacy businesses that are going to struggle. But I do think Disney is a wonderful investment. And when he starts working, which will probably be this summer, half of the money he takes in is going to get invested. And we're going to invest in companies he likes. So when you're 21, the key is invest. It's really important. If you start early, you don't have to save as much money. $1,000 invested at 21 is way better. Even if you only equal the market and get about a 9% return, at some point in your 50s, you're just rolling downhill in terms of how much money that turns into. So I would say, and anyone else is welcome to jump in. I'll let Max Chatsko, who is the closest to 21, jump in next. I would say start with companies you're familiar with. Don't feel like you have to chase the latest new tech stock or something. Now, if those are areas that interest you, I met with a 17-year-old and he asked me about, I want to say, lithium mining. And I had no idea, but he'd really done his homework. And I have no idea if the company he was talking about was a good company or a bad company, but he did the work. Max Chatsko, your thoughts about investing at 21?
Yeah, so I started investing when I was 19, so I was still in college. And one thing I would say is like Dan just said, I mean, pick things you're kind of familiar with. It's very easy, especially as like a 19 or 20-year-old kid, 21-year-old, you get a little cocky, you get a little sure of yourself, oh, I did all this research. This is a slam dunk. You're going to take your lumps and that's okay. But don't get discouraged if you don't have a lot of money when you're 21. You're not supposed to, right? So it seems like futile, right? I only have this much money to invest every month or every so many months. That's okay. That you're right on track. And you have a huge advantage if you start early, and you're supposed to make mistakes and you're going to learn and you're going to refine your process over time. So starting early, even though you make a lot of mistakes, is a great advantage.
We are going to get to a ton of your questions and comments. We're going to take one next from David Strauss. This came to us on Twitter, Sam, if you have that one. The Sam I'm referring to, of course, is our director of marketing, Sam Bailey, who is behind the glass here. I almost never sell, but let's say I needed to sell a stock. I've held shares both long-term and short-term, depending on when I bought. If I were to sell, would I get taxed or at long-term or short-term gains? Which shares get sold off first? Thanks in advance. Steve Symington, you wanted to answer this one.
Right. So it depends on your brokerage, but the default is generally it's like a FIFO method, right? First in, first out. So you generally, if you sell and you don't specify a lot that you want to get rid of, you're going to sell the shares that you've owned longer than the other ones. Some brokerages, I don't know, and correct me if I'm wrong, but you may be able to choose a short-term lot or a long-term lot and pay, sell from that. But I know like E-Trade, for example, you can drop down and say, sell this position. But it really depends on your brokerage. Consult there, take a look. But, keep in mind, generally, if you're going to sell, long-term capital gains is for stocks you've owned for more than a year. You'll pay a significantly lower tax rate. Generally, 15% is what most people will pay. Some people in the lower income tax brackets pay nothing. Some in the upper income tax brackets will pay 20. But short-term capital gains tax rates for any stocks you've owned less than a year are going to be stocks that they will tax you at your regular income tax brackets. So keep that in mind when you're taking profits. Every time you sell and you realize gains, it is a taxable event. And that's something that you should definitely keep in mind. Put that money aside if possible, rather than continuing to trade it and potentially risking it and leaving yourself on the hook for a hefty tax bill at the end of the year.
This is also something you should discuss with a financial advisor, with the CPA, because there are some strategies like harvesting losses at the end of the year, where if you have a stock that's down, but you still want to own it, that you literally could, and it's a long-term hold, you could sell it, use those losses to offset some of your taxes, and then buy it back. There is a waiting period on that. So you want to get proper advice. None of us are CPAs. None of us are tax attorneys, though I'm sure some of us are probably working on that, knowing this group. We are going to take a comment from Mike Fee next, because it's a really smart one. This is a question we get asked all the time. Mike says, new investors, if you're signing up for a brokerage account, consider Schwab, TD Ameritrade, Fidelity, etc. Avoid Robinhood, which offers no competitive advantages, limit stocks you can buy, they don't sell over-the-counter stocks, and has been plagued with outages and PR issues. I think the biggest issue with Robinhood is actually their customer service issues. They have been very difficult to deal with, to get a hold of an actual person. I'm not in favor of any one platform. We use Stockpile for buying our 7investing stocks, but I am a big fan of buy something that allows for fractional shares. I believe Schwab is the one that advertises you can buy slices that are $5. Well, if you're an investor and you have $10 a month to put in, buy a $5 slice of a really good company, and you can feel good about it. That is a great way to get kids investing. If you have a parental account that you're investing for an under 18-year-old, or for college kids, look, you might work a part-time job, be able to put $50 a month, and you can still buy shares of amazing companies. We are going to take Andrew Holder's question next. If you want to pull that up, Sam Bailey. I accidentally skipped out of order. My apologies for that. Max Chatsko, Dana Abramovich. Dana's not here at the moment. Have either of you looked into psychedelics in terms of mental health treatment, or is this still too early to even consider? Max, I had no idea that this was a thing. Have you looked into this?
Oh, I've looked into it, Dan. So I'm actually very bullish on overall psychedelics or some of these natural compounds in mental health. They seem to have very good attributes. So there's a couple companies that are publicly traded. I think the one a lot of people talk about is Compass Pathways. I'm not necessarily, I'm neutral on that. I think it is early, right? We still need to generate and collect robust clinical data proving that these compounds work. And also something to keep in mind, the complexity of biology, right? So when you take a natural product, like say you take magic mushrooms or your microdose, there's a lot of other compounds in that, including the active ingredient. We're not sure if those have an effect on amplifying the benefits of the active ingredient. When we're just isolating that and putting that in a pill, maybe it's not as active or potent, or maybe it has some safety concerns. Like, we don't know. So we have to wait for the clinical data. But I do think over time, these are going to be how we treat things like depression and different mental health disorders. And they have durable treatment advantages, it seems. Like, they have very lasting effects. So very optimistic, but in general, I'm not invested in this space right now. It is very early.
This is something we will keep an eye on. I'm volunteering Max as the youngest of us as a test subject. If any of the psychedelic companies out there, just send them to Max. He'll try them, write a little clinical study. That's not how clinical studies work. We are teasing, of course. No 7investing lead advisors will be harmed in the making of this program.
The FDA has entered the chat, Dan.
We have a great question from VJ, came to us on Twitter. He wants to know what free cash flow means. It's such a basic question, but it's one that reminds us we didn't all come to this knowing all of these terms. We recognize that sometimes this world can get a little inside baseball where we're talking about things. We try a lot on 7investing now to sort of do a reset. There are people out there watching. Look, my mom is watching. She is not a big investor in individual stocks, probably doesn't think a lot about free cash flow. So we are trying to educate to make everyone better investors. Simon Erickson, you wanted to take this one.
Yeah, I love this question. And first of all, Dan, Steve and I are going to be actually recording a podcast that's dedicated specifically to financial statements. So if you kind of are a little unsure about what some terminology means, or what numbers do you look for, or why does all this matter, we're going to actually be dedicating an entire podcast just to education of financial statements, which I'm kind of looking forward to. Steve and I are, of course, going to throw some humor in that too, so it's not completely dry through the whole time. But to answer this question of free cash flow, a lot of times companies look at investors look at earnings per share of a company. Probably the most followed metric of all, at least for quarterly financial reports. But that doesn't tell the whole story, right? Net income, the earnings of the numerator of that, can be manipulated. Companies could be paying a lot of stock out, which is not a cash charge. That is something that works against your net income. They could be depreciating a whole lot of machinery, which is working against your net income, but it's not working against your cash balance. And so one metric that investors tend to look at is operating cash flow and then free cash flow. And so the operating cash flow kind of starts with net income and then makes adjustments to the cash flow statement to take out all of those non-cash charges. So it's actually how much cash is a company depositing in the bank each and every quarter. And then even one step farther than that is if you take out the capital expenditures required for your business, right? You're making acquisitions of companies, or you're buying machinery for your plant. Maybe you're acquiring buildings that you need for your operations. If you take out those capital expenditures, what's left after that is your free cash flow per share. And so really one thing that we tend to look at is we don't just look at earnings per share, we look at free cash flow per share, because that's what's left over after you pay all of your operating and your capital bills. And it's kind of on the table that you can share with your investors, which is what we really care about.
we are going to come to Matt Cochran for a dad joke in about 30 seconds. So Matt, you have about 30 seconds to come up with a joke. But before we do that, I want to remind everybody what we're doing later today. So at about 2 o'clock today, the 7investing team comes together and we are presenting our picks for next month. This is, of course, a recorded call. It gets released on the 8th of the month. So we each do about a 15, 20-minute presentation on our stock, and then everybody else can ask questions. So Dana can ask Max questions, Max can ask Dana questions. For the rest of them, all of us can ask questions is usually how it goes. And it is a really valuable deep dive into the deep thinking we put into our stock picks each month. So if you are a member, and I will bring it up one more time, 7investing.com/subscribe. On the 1st of the month, you get access to our picks. On the 8th of the month, you get access to these deep dive calls. There are a couple of questions that Simon wanted to take on cryptocurrencies. We will get to that in a second, but Matt Cochran, putting you on the spot, do you have a dad joke?
Not really, Dan. Like what I would say though is like I'm a father of 4 children. And, when they were littler, especially, but still today, like I have to spend a lot of time, resources, and money on just child-proofing my house. But no matter what I do, they keep getting back in. So I don't know what to do.
Oh boy. David Strauss says, sorry, I'm late to the stream. Simon, do you feel like the validity of Bitcoin gets impacted when coins that are literally based on a joke like Doge get pumped by the likes of Elon and others? Tune out what Elon Musk is saying. He's trolling you. Elon Musk manipulates things for his own gain and sometimes just to show how important Elon Musk is. Simon Erickson, I have no idea if this is the question you wanted to take, so feel free to seg into any of the other crypto questions we have in the queue.
Well, I had to answer this one because David asked me specifically. So I said, of course, I've got to give an answer. This is exactly how sometimes this short-term trading works, right? Like, David, do you remember a couple of years ago when Long Island Iced Tea renamed its company name to Long Blockchain? Max, I know you're nodding your head. You remember this story. And the value of the stock went up something like 3 times in value in a single day, just because everyone thought they were developing a blockchain. By the way, they were not developing a blockchain. It was still a beverage company that changed in no way whatsoever, just the name of the company. And that was something that is short-term noise, right? If you're investing for 2 or 3 years, you don't care about if it goes up 3 times in value and then comes right back down in 24 hours. Dan, we talk about the cannabis space a lot. Remember Tilray? I think it went up 3 times in value in a month or a couple of weeks there for a little while.
You don't want to buy momentum stocks. You want to buy stocks or cryptocurrencies based on the fundamentals. Part of the reason I've talked about not investing in cryptocurrencies is I don't understand what the fundamentals are, and it's been explained to me by some really smart people. So if I looked at a Tilray, I'd look at their business, and their business, most people would argue, isn't that good. But there's a lot of people in the cannabis space. We see this in the betting space as well. Wow, so many people are going to buy cannabis. Well, yes, but it's also going to become a commodity. So if you're going to bet on a cannabis company, yes, the pun is intended there, you need to find one that has marketable differences, that actually has some reason, a brand, a product, an expertise. Look, coffee's a commodity as well, but Starbucks turned it into a brand. And it's possible in cannabis. It's likely possible in sports betting. It's not super duper likely. I'm going to take a related question from Stock Investor. He says, what do you think of Fubo TV CEO David Gandler talking about his company's stock on Twitter? I didn't see these comments. I'm not a big fan of CEOs talking about their company's stock outside of SEC documents or maybe very well-informed interviews. So yes, they could comment on their stock on a CNBC interview where the reporter has a producer who's done the homework. Fubo, to me, is a giant bear trap, just like we were talking about. Everyone goes, they'll do great because sports betting is going to be everything. Here's the reality. The only proprietary sports they have is they just bid on some like minor soccer game, like qualifying competition. They sell the same product as YouTube TV. They sell roughly the same product as Sling TV. They have a little bit more in terms of live local channels, but they're also a lot more money. There's nothing differentiated about the product, and everyone will have sports betting. I cannot bring this up enough. Just because they run a commercial saying how great they are in sports doesn't mean that they are great in sports. This is a commodity product, cable television repackaged. Everybody, ESPN is going to have direct sports betting in the next few years. This is not something you should get overly excited about. Let's take a question from Financial Dilettante. This is actually one that a lot of us have been debating internally. Sam Bailey, if you want to pull that up. Will you ever pull a past recommendation? How would you come to that decision and communicate? It's easy to imagine a biotech, for example, not playing out the way we hope. Simon, I'm going to let you lead this discussion.
Yeah, thanks, Dan. I mean, this is something we talk about a lot. You know, right now, the way that we have things set up is yes, we can sell a position that's a previous 7 investing recommendation. If we do not believe in the company anymore, and there's a thesis breaker that just everything hits the fan, we want out, we will issue a sell recommendation via email to our subscribers. But our current process is and by the way, we haven't done that yet. We have yet to have that happen, but we reserve the option to do that if we wanted to. But we also right now have the process of we're going to keep it on the scorecard and let it ride so that our scorecard performance reflects all of the good picks and all of the bad picks that we've made. So if you go to 7investing.com/recommendations, you can see that overall consolidated performance. That includes our, hey, we were wrong on this one. But, we're kind of evolving as an organization too. We're starting to talk about, should that really still reflect, if we do make a sell recommendation, should it be recorded in the performance? And we haven't gotten a correct answer or a complete answer for that yet. I think we're still evolving on how we think about that. But I do want to point out that right now we take selling very seriously. Dan, we're not trying to get in and out within a couple of months. We're not doing price targets and we're saying, oh, it's overvalued now over our price target. If we ever sell a 7 investing recommendation and make an alert that we are selling, it's going to be for something really, really bad happening. And at the end of the day, we're still buy and hold investors. Every one of our recommendations, we're not thinking about it short term. We're thinking about it long term.
And we talked about this on the members call as well. A decade from now, we may also look at some of these companies and go, wow, Max said this was going to happen. It took 7 years, but it happened. And now 3 years in, this is a mature company that's become a really good business, but it's no longer a growth investment. And that might be a time where we decide to sell. I gave the example of Starbucks. Starbucks gets to maturity in China. Their partnership with Nestle pays off in their X percentage of grocery sales. They add premium and that grows by 20%. And maybe by then, whoever their CEO is then, that might take a decade, might say, wow, we're just minting money, but we don't really need to grow. Or frankly, some companies get big enough that anything they do to grow, Dollar General just announced a new store concept and they're going to roll out a few hundred of them. A few hundred new Dollar Generals doesn't move the needle. They'd have to roll out, a few thousand of them for it to be a deal maker. So there might be things where it's game over because everything we said would happen, has happened. But that said, that's probably going to take a decade at the earliest on any of these companies. Silvertrap asks, has 7 Investing sold a single stock since its inception? The answer is no. Personally, I've only sold one stock in the past 6 years. I've talked about this a lot. I sold out of WWE because I haven't liked how they've treated people during the pandemic, where they're laying off workers, not high-paid workers, when they're making more money than they did pre-pandemic. Has anybody else, made a sale other than for like trimming or reasons where something grew so big you felt uncomfortable with? Raise your hand if you've made a sale. Simon, what have you sold and why?
I've got to pay you guys, Dan. I had to trim some positions so I can pay for 7 Investing. I guess that's a little outside of this discussion, but still true.
It is, and as a startup company, we appreciate that. Obviously, we started from zero. There are no outside investors in 7 Investing. This is a bootstrap operation, and we are happy and proud that so many of you have decided to join us on this journey. We're going to take just a couple more questions. We're going to take one from our very own Brock Briggs, and then we're going to close out with what's one investing rule you never violate. Sam, if you want to bring up Brock's question, that would be great. What kind of distinguishing factors should we be looking for in new sectors like, say, sports betting? Seems like a lot of people getting into the space, but difficult to tell what will set them apart. Is a basket appropriate this early? So I just gave a little bit of my thoughts, and I'll let Matt weigh in here. Anybody who wants to weigh in. I don't think sports betting is going to have a lot of winners. Now, you could argue that the Penn Barstool deal, that Barstool Sports speaks to a certain audience, and that's going to be a differentiator. I do think that's true, and that Penn will likely be a winner. I'm not sure they're going to be a winner on mobile apps and all the other things. But I do think there will be an audience that goes to those casinos that's looking for that brand. I really think the winners in sports betting are going to be Caesars and MGM. I don't think you can invalidate how big a mailing list they have. And the fact that I go to Caesars because I want to earn loyalty points. Loyalty points when you don't own a casino are meaningless. I could care less about getting a t-shirt. I want to get a comped room. I want to get a free dinner at a steakhouse. Those are meaningful ways to drive business. So Caesars is one of a group that just partnered with the NFL. If I could bet in my state, which I can't yet in Florida, but if I could, when that's allowed, I would use the Caesars app because it would translate into real rewards. I don't see how Fubo, I don't see how Disney, I don't see how anybody competes with that. Matt, do you have any thoughts on sports betting? I know it runs adjacent to some companies you follow.
Not too much, actually. I think you kind of said what I would say. Like, I think it's very hard to differentiate between any of these. The only one really might be Penn, because I think Dave Portnoy is a social media marketing genius, and he does like that customer acquisition cost, just because he's so good at that. It's going to be lower for Penn than maybe some of the other names. But I really don't know. I haven't studied the space much. I don't want to offer too much of an opinion. That's just my thoughts from as an outside observer.
I won't speak too much about David Portnoy, who grew up in my hometown, is friends with my brother. I know the family, but there is good with bad here, and I'll liken it to Elon Musk. Elon Musk could say things that manipulate his stock up, or he could say something that blows everything up. It is always possible that David Portnoy does something where they have to distance themselves from him. He does not shy away from controversy. It's been great for their brand, but as you get into a world that's a little more grown up in the casino space, there are definitely some risks to worry about there. We're going to move to one last question, and I will go around the room. And I am not entirely sure if I sent a finisher graphic to Sam Bailey. So Sam, let me know in the chat if we've done that. But guys, what's one investing rule you never violate? I'll start with Max on this one.
Yeah, so I always develop a thesis, and I will never just buy a stock like, oh, I'm interested in this, I'll just see how it goes. As my team here knows, and anyone who's seen the team calls, I go hard in the paint on my research process. So that's one of my biggest value adds, I think. So I never violate that rule. Always develop a thesis.
Matt Cochran. Sorry, I'm having a conversation in the back. As I said before, I forgot to send our closing graphic. Sam Bailey is doing hero's work and finding it for us. Matt Cochran, what is, I know you have a don't invest on an empty stomach rule, but other than that, what rule do you never violate when investing?
I have a don't do anything on an empty stomach rule. So like, I guess like I would just say I keep things simple. I only go long. I never short stocks. I never do options. I don't use margin, though I'm not like vehemently opposed against like some margin, I guess. But like, I just keep it simple. I only go long and only on stocks like that I want to own as companies, for the long term. That doesn't always work out, of course, but investing's hard enough. Like, you don't need to make it harder by trying to yes, those things can juice returns, but they can also juice the downside too. So I keep it simple, long only.
I'll go to me, and then I'll go to Simon, and then I'll go to Steve. I will say I never invest in companies I'm not proud to own. Now, I have friends that look at it like I will invest in companies that will make me the most money, and then I'll use that money to support things I like. But if I analyze, and some company that sells, tobacco to children in the third world is going to be a huge winner, I look at it and go like, yeah, but like, I don't want to tell anybody I own tobacco for kids or like whatever horrible company it is. Like, I think it's a weird line because I do own companies, that have some human rights violations issues. Apple is a company that, there have been concerns. Nike, I don't own Nike, but Nike, there have been concerns. That said, if it's really an awful one, I am very hesitant to do it. Simon Erickson, what is one investing rule you will never violate?
Well, Max had the best answer, so I have to be a photocopy machine and take his, which is have a thesis. I mean, that is probably the most important investing rule of all, in my opinion. I put a slight additional explanation to that a lot of times when you're looking at kind of growth style investing and companies that have the majority of their revenue or cash flows are in the future, you don't always really know how things are going to go, right? It's not steady state. You don't have a 50% operating margin you can bank on. So it's a little harder, but I think that a good growth style investor will still combine that with looking at something operational, developing a thesis, knowing what this company has to do to achieve in order to reward its shareholders. And that's more than just revenue growth. That's not just, go out and develop a blockchain and change the name of your company to do that. I mean, good growth style investing should say, hey, we want to, if it's a software company, we want to get more subscribers and we want to expand to more services over time. If it's biotech, then maybe there's milestones that they're trying to achieve through clinical trials. I mean, things like this, you want to watch. And then if it's showing well and you see, yeah, company's hitting the high points and doing what it say it's going to do, those are typically good signs rather than just kind of being swayed by earnings per share and revenue growth and the stuff that hits the top of the financial media headlines.
Steve Simonton, you can close out this topic. What is one rule you never violate when investing? One rule you should also never violate is never leave your picnic basket outside. I know you have bears in the backyard there, so be careful with that one. But Steve, what's one investing rule you never violate?
I always think long-term. Like I never, I will take advantage of short-term challenges to buy a business that has a good long-term story, but everything I buy needs to have a compelling long-term thesis. And that's the big key for me, is that I'm not buying a stock because, and sometimes I'll have near-term catalysts and I'll lay those out and say, this could move the stock in the next several months, but it's not crucial to my long-term thesis. And that's what I'm looking for. And, I tweeted something out the other day that said, 10% move is nothing. And we've had people email us and say, hey, your stock that you recommended last month is up 10%. Should I sell? Absolutely not. Like, we are looking for multi-year investments. And, we're talking about businesses that can create life-changing wealth. 10% is indeed nothing. I'm looking for multi-baggers that actually change, kind of the way that you do things and can change your financial situation for the better. But that requires patience and it requires long-term thinking. So always long-term is how I focus.
We appreciate your questions and comments. We see lots of them in there. ZL, Dave Walker, Silvertrap, D. Feel free to share those with us at 7investing on Twitter. If we ignore your question, it's sometimes because we're just out of time, which is basically the case here today. Sometimes it's because that's not a stock we're comfortable talking about on the fly. We might want to do a little bit more research. And sometimes, of course, they're just not stocks we're following, so we're going to pass. But we love each and every one of you. We know you have other entertainment choices. We know that right now you could be watching episode 5 of Falcon and Winter Soldier, or I don't know, Price is Right. I'm not even sure what is on at this time. As the World Turns, I am not entirely sure. Wendy Williams, it could be any of those things. And you have chosen to watch 7 Investing now. We appreciate that. And with that, let's send Steve up on the top rope. Let's hit our finisher. Sam Bailey, thank you for finding the graphic. This is a question I actually asked internally. I'm going to let Simon Erickson have the first answer. Is Coinbase worth $100 billion? About 60% of you said no. 28% said eventually. 12.6% said yes. I have no idea, but Simon Erickson, I know this is one you've been following.
Well, this is a question that takes 30 minutes to answer, unfortunately. And Steve and I did spend about 30 minutes answering it on our recent call with Crypto EQ that we have behind the paywall, if anyone's interested in looking at that. I think that the 20-second takeaway is that crypto is evolving. Cryptocurrencies are evolving to not just being stores of value, but being used for transactions. And Coinbase is a cryptocurrency exchange where you can buy and sell Bitcoin, just like you would buy and sell Apple stock today, kind of like a Schwab or a brokerage. But it's also kind of like a PayPal, where you can actually do transactions. And we think about that like it's crazy today, Dan. We say, how the heck am I going to use a Bitcoin to actually buy something? No, that's never going to happen. That is going to happen. That is definitely on the horizon. And you're going to start seeing this kind of evolve just the way that digital payments have evolved over the past decade. And so the real question to me, I would answer yes. In my personal opinion, I think that Coinbase is worth $100 billion, because it's not only aware of the fact that people are more and more interested in purchasing Bitcoin as an alternative to cash or gold as a store of value, but are also using this as a much more lower friction way of making transactions. And I think that Coinbase is really aware of both of those opportunities. I would probably say yes, personally.
That brings us to the end of this edition of 7 Investing Now. If you have questions for us, if we didn't answer your question, I know Max wants to answer Dee's question, but we have 3 more hours of recording to do for the pitches today. So I'm not going to let the show go that long. You can hit us up at 7investing. That is at the number 7investing. Sorry, Sam, I did it in a different order than what I normally do. I apologize. At 7investing on Twitter. Or if you have a question about our service, about your membership, you're thinking about becoming a member, you want to know, Matt's fried chicken recipe, whatever it is, that is info@7investing.com. I don't know if Matt has a fried chicken recipe. I just sort of feel like he probably does.
I absolutely do. I go to Popeyes. All right, that's my recipe.
Good choice.
We live in the South. There's got to be better fried chicken available than Popeyes. That being said, we have come to the end of the show. We will be back Monday at the regular time. Enjoy your weekend. See you Monday.